Stock that's under pressure is HDFC. The net interest income growth has slowed down to its lowest level in 6 years. CNBC TV 18's Ritu Singh caught up with Keki Mistry, the Vice Chairman and CEO of HDFC. Listen.
When we look at net interest income has two components. First component of net interest income is the difference between the interest that we earn on loans that we have given minus the interest that we pay on money that we borrowed. Now, how much that difference is a function of two things. It's a function of spread and it's a function of growth. So if you look at the growth numbers, the individual loan book after adding back loans sold in the previous 12 months grew 23%. Non-individual growth was lower at about 8%. And if we look at spreads, which is the second element, spreads have actually gone up a little bit compared to what they were in September last year. So last September spreads were 2.29%. This September spreads stand at 2.32%. So it's a marginal 3 basis points improvement in spreads. Though I must say that in March also spreads were 2.32%. So compared to March, in September spreads remain unchanged. So on that front, net interest income growth should be in line with the balance sheet growth. But the second element of net interest income is the money that we earn on shareholders' funds.
Right.
Now we have 34,000 crores of shareholders' funds. That 34,000 crores has zero cost. There is no cost because it's shareholders' money. The cost is only the dividend which comes as an appropriation from profits. Shareholders' funds earn the interest rates that are prevalent in the system. So if interest rates come down in the system, theoretically, let's say by 125 basis points, then the amount that we will earn on 34,000 crores, which ultimately goes into net interest income, will also come down by 1.25%.
Okay.
And that's effectively what has happened.
So I appreciate...
So let me put that a little differently. It is theoretically possible, for a company to have lower spreads and therefore a worse operating performance and yet report a much higher net interest income simply because interest rates in the system have gone up a lot.
I appreciate that point about your shareholders' income, but tell me about your loan growth. That is key to you. At 12%, if you exclude the loans that were added back in the last 12 months, 12% growth is one of your lowest numbers that we've seen since 2010. What is the reason for that? Even though your individual loan book is growing so fast, why do we see that slowdown?
If we look at our lending, there are two components of our lending. One is individual loans and the second is non-individual loans. If you look at individual loans, very honestly, it's been reasonably business as usual.
Right.
Our average loan size for new loans we given in the current year is 23,60,000. So we've grown both in terms of number of applicants, number of new customers, as well as a marginal increase in the average loan amount. The increase in average loan amount is not much. It's more driven by increase in number of customers. So if we add back the loans sold, the growth is 23%. Now, this year, the quantum of loans that we sold is much higher than the quantum of loans we sold in the past. So in the last 12 months, which is from October last year to September this year, we have sold loans aggregating in all to 12,969 crores of rupees, which compares to a little over 7,000 crores when we were talking of September 2014. So compared to that, loans sold have increased by 5,000 crores. So therefore, when we add back the loans sold, the growth is back to where it was, 23%. But when we remove the loans which have been sold, the growth looks a lot more muted.
All right, that's the word coming in from HDFC. But once